Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the boring corporate documents that actually control our world. And today we're diving deep into the Toro company's latest 10K report. If you own a lawnmower or have ever hired a landscaping company, chances are you've heard of Toro, but what is really going on behind the scenes? Well, we're about to find out, so stick around. Oh, and before we jump in, if you love getting these straightforward insights from real corporate filings, make sure you are subscribed and hit that notification bell. We also have a fantastic community over on our Discord server linked in the description below where we break down these documents together. So the Toro company just dropped its Form 10K for the fiscal year ending the 31st October 2025, and we're going to cut through the jargon to see what it all means for their business and for us as investors or customers. Let's get straight to the numbers that matter most. The Toro company reported net sales of $4.51 billion for fiscal year 2025. This is a slight decrease of 1.6% compared to $4.58 billion in 2024. Now that might sound like a small dip, but it tells a story. Their professional segment actually saw a nice increase of 1.9% in net sales, reaching $3.62 billion. This is great news for their business side of things. Landscaping companies, golf courses, and construction crews are still buying Toro's products. However, their residential segment took a hit with net sales dropping 14.0% to $858.4 million. This means fewer people bought their lawnmowers, snowblowers, and yard tools for their homes. We'll have to dig into why later, but it suggests homeowners might be cutting back on discretionary spending, or maybe Toro is facing tougher competition in this area. Looking at their profitability, their gross margin was 33.4%, down slightly from 33.8% in 2024. Now, margin is essentially how much money they make after paying for the direct costs of making their products like materials and labor. A small drop here can mean tighter profit margins for the company, so they need to be efficient. Interestingly, their adjusted gross margin, which gives a cleaner look at core operational profitability, actually improved to 34.1% from 33.9%. This tells us that while overall costs might be up, their core business operations are still strong. Now here is a really interesting item. A non-cash impairment charge of $81.1 million hit their books in 2025. This is a big write-down on the value of an intangible asset, specifically the Spartan trade name. Think of it like a company realizing that a brand name it owns isn't worth as much as it thought. This really impacted their reported net earnings, which fell to $316.1 million or $3.17 per diluted share, down from $418.9 million or $4.01 per diluted share in 2024. But if we look at adjusted net earnings, which removes these one-time hits, Toro's adjusted net earnings were actually up slightly to $419.6 million, or $4.20 per diluted share from $435.2 million, or $4.17 per diluted share in 2024. So the core business is still chugging along even with that big brand name write-down. Let's talk about inventory. Field inventory, which is the amount of product their dealers and distributors have on hand, was lower at the end of 2025 than in 2024. This is generally a good sign. It means they are selling more product and not building up potentially obsolete stock. Their order backlog also decreased to $0.8 billion, down from $1.2 billion. This suggests that they are improving their manufacturing output and lead times are getting back to normal, which is crucial for meeting customer demand and avoiding lost sales. Now let's talk cash. Cash provided by operating activities was $662 million in 2025, a nice jump from $569.9 million in 2024. This is a really positive sign, showing they are generating a healthy amount of cash from their day-to-day operations. And their free cash flow, which is the cash left over after they pay for essential investments like new equipment, was strong at $578.3 million this year, up from $470.7 million last year. This is the cash they can use for dividend, share buybacks, acquisitions, or paying down debt. Looking at their debt, they have a total of about $921.5 million in long-term debt. This breakdown shows a mix of senior notes and term loans. It is important to note they recently took on a new 5.27% senior note due in 2032 for $200 million, which helped them pay off a previous term loan. Their debt to capitalization ratio is about 38.8%, which is manageable, but something to keep an eye on, especially with rising interest rates. Now, no corporate filing is complete without a deep dive into the risks, and Toro has a lot. They're worried about economic conditions worldwide, which is understandable given today's global climate. They also highlight supply chain disruptions and shortages of parts, which we've all felt. Weather conditions exacerbated by climate change are a big concern too, with unusual wet or dry periods impacting sales and even their own operations. Competition is another major theme. They are up against many companies, big and small, and in some areas the barriers to entry are low, meaning lots of players can pop up. They mention the price wars in residential products and how fluctuations in the US dollar affect their competitiveness overseas. And here is something a bit unexpected. They're very concerned about cyber squatting and domain name scams. It sounds minor, but they believe it could harm their brand reputation and even lead to legal trouble if consumers are misled. Toro is also actively pursuing acquisitions, one notable one being Tornado Infrastructure Equipment Limited in Canada for about 279.3 million Canadian dollars. They believe this will strengthen their professional segment and expand their dealer network. However, they are also very upfront about the risks involved in integrating these acquisitions, delays costs, and not realizing expected synergies can really hurt their financials. Sustainability is a big buzzword these days, and Toro acknowledges increasing scrutiny on their sustainability practices. They're setting goals for battery and hybrid product sales and GHG emissions, but admit there is no guarantee they'll hit them. Falling short or facing negative public perception could hurt their brand. And finally, they're concerned about protecting their intellectual property. They own patents and trademarks, but admit these might not be enough to stop competitors. And they're also worried about potentially infringing on others' rights, which can lead to costly lawsuits. So what is the big picture here? Toro has a solid professional segment showing resilience and growth. Their residential segment is struggling, indicating a need for strategy adjustment, or maybe it just reflects the current economic climate for consumers. The big impairment charge on the Spartan brand is significant and shows that even established brands can lose value. They are actively managing their finances using debt wisely and generating good cash flow, which is a strength. However, the risks are substantial from global economics and fierce competition to supply chain woes, and the ever-present threat of climate change impacting their business. Their strategy of acquisitions is a double-edged sword, offering growth, but also introducing integration risks. My take is that Toro is a well-established company with strong roots in its professional markets. Its ability to generate cash and its proactive approach to managing debt and investor returns through dividends and buybacks are commendable. However, the decline in the residential segment and the significant brand impairment raise red flags that warrant close monitoring. They need to either revitalize that segment or pivot resources effectively to capitalize on the profitable parts of their business. The acquisition of Tornado Infrastructure Equipment is a big bet, and its success will heavily depend on smooth integration. The future looks cautiously optimistic if they can navigate these challenges, especially the residential market decline and the integration of new acquisitions. Alright, that is our breakdown of the Toro company's latest filing. What is your take on these numbers, and what do they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.